CoreWeave, the AI cloud infrastructure company, GPU clusters for frontier AI serving Microsoft, OpenAI, Meta, and Anthropic. FY 2025 revenue $5.1 billion, up 168%.
CoreWeave operates 32 data centers with 1 gigawatt of active power and a $99.4 billion revenue backlog. The company IPO'd on NASDAQ in March 2025.
Michael Intrator, Brian Venturo, and Brannon McBee co-founded CoreWeave in 2017 as Atlantic Crypto, Ethereum miners who pivoted to GPU cloud after the 2018 crypto crash.
OpenAI selected CoreWeave as a training infrastructure partner in 2022. NVIDIA made a $100 million equity investment in 2023, cementing CoreWeave as the preferred neocloud for frontier AI.
The March 2025 NASDAQ IPO raised $1.5 billion at $40, the largest AI IPO by proceeds. OpenAI announced an $11 billion compute deal on day one.
CoreWeave earns revenue from long-term contracted GPU capacity, dedicated NVIDIA clusters for AI training and inference. Microsoft generated 67% of FY 2025 revenue.
The revenue backlog, $99.4 billion in contracted future revenue, up 49% sequentially. FY 2026 exit run rate guided to $18 to $19 billion.
FY 2025 revenue of $5.1 billion grew 168%. Adjusted EBITDA margin reached 48%. Free cash flow was negative $9.3 billion, funding $31 billion in infrastructure.
Q1 2026 revenue $2.08 billion, up 112%, beating every analyst estimate. Adjusted EBITDA hit 56% margin. Net loss of $740 million from interest expense.
Amazon Web Services and Google Cloud offer GPU compute at scale. Microsoft Azure is CoreWeave's largest customer and most direct competitor, a structural tension defining its long-term risk.
CoreWeave's moat is specialization and speed, provisioning GPU clusters in days, not months. NVIDIA's equity stake and early Blackwell allocation reinforces this first-mover infrastructure advantage.
Lambda Labs and Nebius target AI startups with on-demand GPU rentals at lower prices. CoreWeave targets enterprise-committed clusters, a different motion with higher switching costs.
CoreWeave operates 32 data centers across the US and Europe, with 1 gigawatt of active power. Contracted capacity is 3.5 gigawatts, targeting 8 gigawatts by 2030.
The Meta and Anthropic multi-year agreements in 2026 reduced Microsoft concentration. CoreWeave now serves every major frontier AI lab globally as a dedicated compute provider.
Michael Intrator is co-founder, chairman, and CEO, a former commodities trader who managed environmental markets portfolios and a natural gas hedge fund before founding CoreWeave.
Intrator holds a BA from Binghamton University. He won EY Entrepreneur of the Year in Technology Infrastructure in 2024, the year before CoreWeave's NASDAQ IPO.
The AI cloud infrastructure company, $5.1 billion in FY 2025 revenue at 72% gross margin, building the GPU backbone for Microsoft, OpenAI, Meta, and Anthropic, with a $99.4 billion revenue backlog.
Q1 2026, revenue $2.08 billion, up 112%, beating all 32 analyst estimates. Adjusted EBITDA 56% margin. Q2 guidance missed consensus by $165 million. Stock fell 10%.
Imagine a company that went public less than 6 weeks before its first earnings report and then posted a revenue backlog approaching $100 billion. That is CoreWeave, the AI cloud hyperscaler that may be the most important infrastructure company nobody has heard of. Today we break down Q1 2026, their first quarterly report as a public company.
CoreWeave was founded in 2017 as a cryptocurrency mining operation in New Jersey. When crypto turned, the founders pivoted to AI workloads. That bet turned a GPU mining shop into the most talked about AI infrastructure company of the 2020s. They went public on March 28, 2026 at $40 a share, and by earnings day, the stock had nearly tripled.
The business is straightforward to describe and brutally expensive to build. CoreWeave owns massive GPU clusters, primarily NVIDIA H100s and H200s, and rents that compute capacity to AI companies and hyperscalers who need more GPU power than they can build themselves. Think of it as the wholesale electricity market for artificial intelligence.
Revenue for Q1 2026 came in at $2,078 million, up 112% year over year. Analysts were expecting $1,970 million, a 5.5% beat on the top line. The company more than doubled revenue in a single year. Q1 2025 was $982 million. This is one of the fastest revenue ramps in enterprise tech history.
Gross profit was $1,362 million, a gross margin of 65.5%. Margins have compressed from 73% a year ago as newer capacity onboards at lower initial utilization. The operating loss was $144 million GAAP, but adjusted EBITDA was $1,157 million, a 56% adjusted margin.
The metric every investor is watching is the revenue backlog. At quarter end, CoreWeave reported $99.4 billion in contracted future revenue, up nearly 50% from the prior quarter and roughly 4 times larger than a year ago. They booked over $40 billion in new customer commitments during Q1, the strongest bookings quarter in company history.
On infrastructure, CoreWeave crossed 1 gigawatt of active computing power. Total contracted capacity now exceeds 3.5 gigawatts. By end of 2026, they target 1.7 gigawatts active, with a long-run vision of 8 gigawatts by 2030. For context, 1 gigawatt powers roughly 750,000 homes, except here it is powering the world's largest AI training runs.
Guidance. Management reaffirmed full-year 2026 revenue of $12 billion to $13 billion, implying roughly 148% annual growth. Q2 is guided to $2,450 million to $2,600 million. Capital expenditures for the year were raised to $31 to $35 billion, more than many S&P 500 companies generate in total revenue. 32 analysts cover CoreWeave. The consensus is buy with an average price target of $128, about 12% upside from the May 8th close of $114. Wells Fargo raised to $155. Jefferies has a strong buy at $160. Even Mizuho, who has a hold, bumped to $110. The IPO coverage ramp is still early and targets are moving higher.
The EPS miss rattled the market. CoreWeave lost $1.40 per share on a GAAP basis. The street was modeling a loss of 91 cents, a 54% miss. The stock fell over 11% on May 8th. Most analysts told clients not to panic. The revenue beat and the backlog surge tell a fundamentally different story than the headline EPS number.
On the call, CEO Michael Intrator said, quote, "There is no part of this that surprised us. We understand the physical ramp associated with bringing compute to the market." He pointed to an inflection in Q3 and Q4 of 2026 as capacity moves from construction to active revenue. He also noted the company secured an $8.5 billion term loan priced under 6% and received a $2 billion equity investment from NVIDIA.
CEO Michael Intrator co-founded CoreWeave and steered it from crypto mining to GPU cloud. Before that, he was a portfolio manager at Point72. His capital markets background explains why CoreWeave approaches debt structuring and return on invested capital the way most tech founders simply do not. He has been the voice behind every major financing milestone.
The bull case for CoreWeave starts with scarcity. GPU compute is the oil of the AI economy. CoreWeave has contracted 3.5 gigawatts of capacity before most hyperscalers have broken ground on comparable build-outs. The $99 billion backlog represents nearly 8 years of forward revenue visibility at today's run rate. Scarcity plus long-term contracts equals pricing power.
The NVIDIA relationship amplifies that advantage. CoreWeave gets preferential H100 and H200 GPU allocation because NVIDIA holds equity. In a world where GPUs are rationed, being first in line is an existential edge. And analysts expect the customer base to diversify beyond Microsoft as enterprise AI adoption broadens, reducing the concentration risk that sits at the top of every bear thesis.
The bear case begins with Microsoft. One customer accounting for roughly 60% of revenue is a single point of failure risk. If Microsoft builds more of its own capacity or slows AI spending, CoreWeave's top line is immediately exposed. A large customer renegotiating contract terms could reshape this story overnight. That is not a theoretical concern. It is the dominant risk cited by every hold-rated analyst.
The CapEx math is the second bear argument. 31 to 35 billion in capital expenditures in 2026 alone. Free cash flow last quarter was negative 4.7 billion. The company must continuously access debt and equity markets. If rates rise or credit markets tighten, the funding model faces serious strain. The $25 billion debt load has interest expense approaching 700 million per quarter.
Gross margin compression rounds out the bear case, down 8 points in a year from 73 to 65%. New data centers come online at lower utilization and drag margins until they fill up. If capacity build outpaces demand absorption, the profitability inflection management is promising, keeps getting pushed further into the future. Bears ask, when does this actually hit positive free cash flow?
On the peer comparison, CoreWeave competes with Amazon Web Services, Microsoft Azure, and Google Cloud, all of which have massive GPU infrastructure of their own. The key difference is CoreWeave offers bare metal GPU access at scale without the overhead of a full cloud stack. For large AI training runs, many teams prefer the density and latency profile of CoreWeave clusters.
Lambda Labs and Vultr compete at the smaller end of the GPU cloud market, but cannot match CoreWeave's scale, NVIDIA access, or multi-year contract structure. The more relevant comparison may be to the data center REITs, Equinix and Digital Realty, which CoreWeave resembles structurally. Heavy asset, long-duration contracts yield-like returns once the build cycle slows.
Valuation context. CoreWeave trades at roughly 10 times trailing revenue, not cheap for a money-losing company. But on FY 2026 estimates of 12.7 billion in sales, the forward price to sales drops to under 5. If you believe the revenue guide is credible and margins stabilize, that looks different than the headline loss numbers suggest.
On options activity, the post-earnings picture was cautiously bullish overall, put-to-call ratio near 0.85. Traders bought puts at the $53 range as a hedge against the IPO lockup expiration later this year. Call open interest was concentrated at the $120 and $150 strikes, suggesting institutional positioning for the Q3 and Q4 inflection management flagged.
On options activity, post-earnings flow showed a put-to-call ratio near 0.85, cautiously bullish, but with notable hedging. Traders concentrated put buying around the $50 to $55 range, which maps to the IPO price plus a modest cushion. That zone represents the technical support level analysts have flagged as the floor if the AI spending narrative softens. Call open interest at the 120 and 150 strikes suggests longer-dated upside positioning.
On insider activity, 0 buys and 0 sells, but that is the IPO lockup at work, not a neutral signal. Insiders cannot sell until late September 2026, approximately 180 days post-IPO. CoreWeave employees and early investors are sitting on enormous paper gains from the $40 IPO price to over $100 today. When that lockup expires, the market gets its first real test of whether insiders believe in the long-term story. Do not read silence as conviction. Read it as a contractual restriction. Size your position with that supply event in mind.
CoreWeave is the clearest expression of the AI infrastructure supercycle thesis. Revenue doubled, backlog hit 100 billion, and management is guiding for 12 to 13 billion in full-year sales. The EPS miss reflects the cost of building at hyperspeed, not a broken business model. The question is not whether CoreWeave is growing. The question is whether investors are patient enough for the inflection. Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.